Krishnan sir. So, நீங்க ரெடியா இருக்கீங்களா?
கால் பண்ண வரதுல
ரெக்கார்டிங் அவர் கால் பண்ணாங்க. அவர் ரெடியா இருந்தா தான் நான் வெயிட் பண்ணேன்.
ஓகே தோ கால் பண்ணி சார்.
நான் அட்மிட் பண்றேன் சார். இப்போ I have admitted everyone, sir. You can start, sir. Rest will join gradually.
Very good morning to one and all, dear members. On behalf of SIRC of ICAI, I welcome you all for the morning weekend session on Ind AS. We have with us CA Chinnsamy, practicing chartered accountant. He is a fellow member of the Institute of Chartered Accountants of India, an associate member of the Institute of Cost Accountants of India, a practicing chartered accountant since 2002. He has addressed more than 70 continuing professional education CPE programs for chartered accountants, author of the book titled Accounting Standards for Chartered Accountancy course. He has presented articles in SICASA newsletters of the Institute of Chartered Accountants of India, presented articles in SIRC newsletter of our institute. His areas of specialization is statutory audit, internal audit of banks, public sector undertakings, and private limited companies. He gives advisory service on IFRS Ind AS due diligence audits. His representation on behalf of the client for the income tax assessment and appeals. He licensed with Reserve Bank of India with respect to FEMA and other statutory compliance related matters. He licensed with DGFT, Ministry of Corporate Affairs, MCA, Goods and Service Tax Department, GST, Central Excise Customs Department with respect to statutory compliance and registration. With this few words, I would like to introduce the speaker of this morning session, CA Chinnsamy, to this seminar session. Thank you, sir.
Thank you, sir. Good morning, all of you. Thanks to CA Krishnan sir for those kind words and introduction. Now the remaining time, I'll try to add value to our learning. See, because accounting standards are not new, but by now, I believe like because of this series of program, we would have been reminded of significant differences in Ind AS. In fact, one of the senior members of the profession with the 40 plus years standing shared in a CP meeting, whatever I learned as accounts in my student days, if I adopt that for Ind AS companies, the professional ethics related issue may come on me. Like that, he made a statement. Very true. Today, drastic changes. And I would like to make it as participative as possible so that the enlightening of key concepts happen in a question answer model. That is much better. But let us strengthen our core understanding. core understanding. Now, to start with, all of us, whether it is AS companies, Ind AS companies, we come across this terminology called provision for bad debts, right? Provision for bad debts. Today, after insolvency and bankruptcy code, this become all the more important. And today we are going to discuss two different Ind AS within this allotted time. Ind AS 37, which is provisions, contingent liabilities, contingent assets, and another Ind AS 40, which is on investment property. Some of the property companies, and when they account and when they classify their land and building as investment property, what are the related consequences? Those things we will discuss in detail to the extent possible within the time limit. Now, to start with, let us go to Ind AS 37, which is on provisions, contingent assets, contingent liabilities. So, this standard, Ind AS 37, there is a parallel standard which you have, and that standard is Accounting Standard 29. Anyway, for companies having net worth of 250 crores or more, this Ind AS only applicable. AS not applicable. By now, all of us are familiar with this. What are the implications of this? And of course, in big listed companies audit, there is always debate in the audit committee meeting whether the standard relating to provisions apply or not applicable. In every audit, I would in fact challenge at least this is one, a kind of a practice, insight, or strategy also. In every audit, there would be some points relating to this. I will share one such practical example also slightly later, in which there was huge debate between the audit team members and the company representatives, the employees. Why all that also we will discuss in detail. Finally, what we concluded also I'll share with you. This happened around some 5-6 years back. So I will share that also. First, let us go to objective. Any accounting standard or Ind AS for that matter, the way we have to understand is like first the scope, first the objective, and then go to scope, and thereafter recognition, measurement, disclosure. Structure it in this manner, and when you approach that standard with this in mind, because there are about 92 paragraphs in the standard, it is as good as several sections, subsections in a barrack. But we are not going to read everything, and we know what to refer for a particular scenario. Like that, if you have this overview in mind, referring a particular point will be very easy. Today, of course, with the Google search and other available search engines tools, we are able to, go to the point you want. But another equal challenge is there is flooding of information in the form of articles. Several articles are available in the public domain, like Tax Guru. So many are giving clear tax, all this. So those are all author's opinion. And in that, what you want, if you want to get it exactly, referring bare standard is the first step, recommendatory. And for many standards, they publish educational material on the concerned standard. ASB published this. Going by that would be very helpful. Even on provisions, there is one such publication. It is slightly old. It doesn't matter. You can still refer. Now, this Ind AS 37, two important objectives. One is the recognition and measurement. In fact, if you see there are three branches: provision, CL, CA, contingent liability, contingent asset. Our existing 29, accounting standard 29, never spoke about measuring of contingent asset or disclosure of contingent asset. At best, it used to be given in director's report. That was the scenario. Now, this is slightly different. Ind AS require the disclosure. We will see more about it. I'm talking about the contingent asset, when we will disclose, when we will treat it like actual asset, that part. When there is virtual certainty, there are three things which we will interchangeably use in this standard: probable, possible, remote. We call it as PPR analysis. for our, I mean, the work culture. So, SOC they call, Statement of Changes in Other Equity. That is SOC. The practical work culture, related acronym. So here we call it PPR analysis. This is what is your decision making regarding provision. PPR, probable, possible, remote. Above all this, virtually certain. Probable, dictionary meaning different. Dictionary meaning you may have different meaning. I'm not talking about that at all. Probable chances of occurrence more than 50% for accounting standard purpose. Possible means less than 50%. Remote means negligible. So the words when it is used in this standard have this kind of an understanding in mind so that you will get the meaning exactly. So even though we talk about recognition and measurement in the first box, recognition and measurement exactly applicable only to provision and not to contingent liability. Contingent liability, disclosure. Contingent asset, disclosure. We will discuss that slightly later. So the idea, the objective is to disclose sufficient information to enable better understanding for the user. Now, I spoke one word, provision for bad debt. I'll come to that slightly later after discussing the key point like what is provision. Even that definition is changing, but meaning more or less same, like AS 29. The provision, what is provision? Even that definition, it is changing little bit, like one line definition only now. We will go to that. So here we will discuss the provisions and contingencies. For that, three important things, as I was saying: recognition, measurement, disclosure. Before entering into this zone, you should know scope, where it is applicable, where it is not applicable. In scope, I will discuss that provision for bad debt. So regarding recognition, we recognize only provision when contingency also recognized, when that is also getting recognized, when your contingent liability, when it become actual liability, like a court case, and court case decided last year we are disclosing it as contingent liability, current year the judgment has come, we are not going on appeal, then it becomes certain, and legal opinions are part of this particular standard. Regarding certain matters, we may seek legal opinion. Prima facie, there is a difference between liability and provision, which all of you know. So liability, it is certain, there is no uncertainty, there is no estimate involved in liability. But provision, there is estimate. Let us keep it very simple. Basic example. Basic example. Suppose there is a stationery vendor. They supplied to various branches of the company stationery worth some 1 crore to the various branches, but they did not submit the bill before 31st March. Now, what is ideal? The accounts team will ask the bill and book. That is ideal. Suppose due to some reasons they were not able to get the bill. Second option, because of past experience, we will be able to estimate. And in that case, can we make it provision? That is what is the whole discussion is all about. And the latest on this is the decommissioning liability. Decommissioning liability. All of you would have come across Ind AS 16, I believe, in which one of the cost components is decommissioning liability. So the decommissioning liability journal entry, if you want the basic aspect, you will debit the PPE, credit provision for decommissioning liability. I used the word provision. We cannot credit decommissioning liability account because at that time we are not liable. So what is decommissioning? It is incurred for dismantling, like dismantling our nuclear plant. It is like that. So for that purpose only we incur decommissioning liability. It is invariably paid at the end of useful life of the asset. That's why I quoted nuclear plant example, which you can easily assimilate. See, a company operating in nuclear energy or related things, they cannot dismantle the plant and move away. They have to properly, as per safety protocols, properly they have to dismantle. Sometimes the reality, dismantling cost is higher than the installation cost itself, reality. Such being the case, I cannot account 20th year, 5th year, 10th year, whatever may be the useful life. I cannot account 10th year amount in year 0. I mean the beginning, initial recognition. So we need to discount present value. Discounting is order of the day for Ind AS. I will try to highlight some more revenues which are interconnected to Ind AS 37 and where extreme application of this discounting present value concepts are there, you can take it like it is more accurate. Then in the measurement, we will revolve around best estimate. We will be considering some probabilities arising out of past experience. That's what is that risk and uncertainties. And present value, just now I spoke about this. The whole standard will revolve around this. AS, there is no discounting at all. There is no concept of present value at all. If it is a AS 29 company, there is no need or requirement to discount anything. But in AS, several standards require discounting. Then for the expected disposal of asset related points and some of the future events also we should consider. Two things will come very often: present obligation. Within the present obligation, it could be legal or constructive obligation, which we will discuss very often in this standard. And unwinding of interest. It is popular across various Ind AS. By now, you would have come across many, I suppose. It is there in financial instruments. I hope by now you are aware. Preference share capital, right? Preference share capital. Where do we group? We can participate little bit. We can participate preference share capital. What is the present classification? Is it equity? Preference share capital. Now you can participate, unmute yourself, feel free to speak. Or you can participate through chat also. Preference share capital. What is the classification in our Ind AS financials? Preference share capital. Yeah, go ahead. No problem. See, it is only updation, right? See, the standards, what we all learned, that generation different. Today, what we are applying is entirely, it is like GST we never come across during our student days, but after practice only we are adopting. Like that, Ind AS. So nothing wrong in deviation in answer. You understand it in a particular perception and answer. All this doesn't matter. Kindly participate. Now, let me go through the chat. Preference share capital is a liability. Nice, great. If non-convertible or voting rate, then it is debt, else equity. Okay. So many answers I'm getting, good responses. Fixed rate of dividend, then liability. Equity or liability. Only few are saying equity. For your information, those days have gone. Preference share capital is entirely liability. Exceptional equity. Exceptional. Now follow something very, very important I'm going to share now. Things don't end there. Things start there. So, okay, let it be liability. What is the consequence of treating it as liability? What is the consequence? Let it be liability. Follow now. Few minutes only. But you will understand the intensity of Ind AS through this. This preference share capital, which you used to write under share capital, old balance sheet, equity, current balance sheet, we shift to debt, long-term liability. What else can happen? Like that, don't think. That is where things start. And you have to account it based on something called the effective rate of interest, not your coupon rate. What is that coupon rate? If I am saying 9% preference share capital, 9% is the coupon rate. We cannot use that. We cannot use that. Most important, your face value will not appear as preference share capital now in balance sheet. What more you want? And we will discount that. And there is a fair value measurement required. That is what is your effective cost. I mean, that effective interest method is nothing but IRR. It is nothing but IRR. Many of you may be knowing this. Some of you would have done in your academic side this calculation, but practical repercussions are very serious. Very serious. And the consequence is the face value won't tally now. See, something very, very important, very significant. Imagine this first. You are going to account two different interest. I cannot call it dividend anymore. Very rarely it is equity. I would say it is only in the academic side, it is possible to have it as equity. Even compulsorily convertible preference share is not equity. is not equity. There are two, Arul Murugan, this is to clarify your point very specifically. Even compulsorily convertible, I am reminding this again. Compulsorily convertible preference share also entirely not equity. There are two series of cash flows. What is that? One is I pay dividend, that is liability component. When I pay dividend in cash, liability component. Redemption may be equity component. So there is liability. Maybe at best one part would be equity. That is what we call it as equity component. Remarkable in terms of accounting. In classroom, how comfortable we were those days. We used to debit bank account, credit preference share capital account. Now it is no longer equity. This is one indicator. Similarly, decommissioning liability present value. Suppose I have to pay X amount in 10th year at the end of useful life. I need to discount, take the present value today. That is the impact of your unwinding of interest. I think I made it clear. Preference share capital, I said it is liability by and large. Even compulsorily convertible preference share, liability component is there. At best, one component can be equity. There are two streams, series of cash flow. Whenever there is obligation to pay cash, that is why I took you to preference share capital. Whenever there is obligation to pay cash, then that is called your Ind AS language, contractual cash flow. Contractual cash flow. What is the contractual cash flow? We need to pay dividend, preference dividend. Discount that, arrive at present value, that's your liability component. And irredeemable preference share not possible. It will have a fixed redemption period. Compute your dividend, arrive at present value, that is liability component, even in convertible preference share. That's okay. Second part, what I said is alarming. Why? You will add the effective interest, deduct amount paid, which is called contractual cash flow. So you will pay every year preference dividend, right? That has to be deducted. So your closing outstanding will not tally with the balance sheet, I mean the face value. Previously, if you prepared AS balance sheet, you would have taken it as equity and you would have taken the face value. Now that won't come. That's the point. So like that here also, your provision is an accounting estimate. Your accounting estimate. Now, another important point, provision for bad debt. Which accounting standard applicable? Provision for bad debt. Can you answer that? Then the disclosure is there in this slide. We will go to that. Can you answer provision for bad debt? Kindly participate in chat. Kindly participate in chat. You can unmute. You are welcome to speak. No problem. Provision for bad debt. Which Ind AS applicable? Which Ind AS? We are discussing a standard with similar title, right? Which Ind AS applicable? Provision for bad debt.
Sir, it is Ind AS 115, sir.
115 to some extent. IFRS 9. 9 is 109, our language. Very good, Deepak. Nice. And Mr. Anand Verma, 109. Many are aware that's a good sign. One thing I'm happy is no one said Ind AS 37 so far. To that extent, I'm happy. Because in other forums, when we ask this knee-jerk reaction, they will say Ind AS 37. Our accounting standard means AS 29. Reality, this standard never talk about provision for bad debt. Your current language, Ind AS language, it is called expected credit loss. How to estimate and all, they would have discussed, I think, that standard over 109. And there is this LR, very popular, loss rate, that is equal to your provision for bad debt percentage. So it is called expected credit loss. This standard not applicable. To a very little extent, 115 applicable. I can say almost 109. There is very little reference with respect to 115. Now, where this standard applicable, where it is not applicable, that is where I said for provision for the bad debt, this standard will not apply. Because the definition provision, it is defined. We will go to that after finishing the scope. It is not applicable. This is exception. Executory contract except to onerous contract. Executory contract where both the parties have obligation to perform. That is called executory contract. Where both the parties have obligations to perform. That is called executory. In simplest language, I'm telling. Then, if it is covered by another standard, when we talk about impairment in the value of asset, like trade receivable related impairment, is what we call it as expected credit loss. Impairment on PPE or other standard, I mean other intangible asset, those are all covered in Ind AS 36. So there are standards where the specific elements of provision are discussed, then that standard applicable, this standard will not applicable. We have a list, we will go to that. And another important point, this executory contract, when it will become onerous contract, when the expected benefits of the contract, when they are less than the cost, that is what is called onerous contract. So these are contracts under which parties have not performed any obligation yet to start, kind of a scenario, or they perform equal extent and there is something pending still. That is executory contract, contract in progress in short. Now, exception, operating lease, the equipment lease, real estate contract, service contracts, this is where the executory contract and elements of onerous contract will come. We will discuss this based on availability of time after finishing the basics. So onerous contract, I said just now, that is why it is given in a picture form of expression to quickly grasp. So it is the unavoidable cost exceed the economic benefit. That is what is executory, I mean onerous contract. That is where executory contract becomes onerous contract. Now, another important point. What is unavoidable cost? There is some technicality here. So unavoidable cost under a contract is, it is like the business prudence kind of a thought process. There are two things here, cost of fulfilling the contract and compensation paid for non-compliance, failure to comply with the contract. Among the two, whichever is less, right? That is what is called the cost, unavoidable cost. We will first finish other exceptions and then we have to again spend time on onerous contract. So when it is covered by another standard, this standard not applicable. Financial instruments, 109 cover. So this standard is not applicable. When it comes to income tax, Ind AS 12, right, that is applicable. So this standard will not apply. Leases, Ind AS 116 applicable. Employee benefit, we have this constructive obligation, which is very relevant in the context of employee benefit. Example, festival bonus. And we know one corporate in Chennai, they used to give one sovereign gold coin to their employees during the Ayudha Puja festival. Very practical. And no law says this, you know better. So this performance obligation, it arises out of established past practice. Even those related things, whatever governed by Ind AS 19, it could be long term, and it could be termination benefit related present obligation, and there are plan asset, defined benefit obligation. There are two types of model, defined contribution plan, defined benefit plan. Everything is covered in 19. Insurance contracts as governed by 104, that is also not covered here. And then the business combination related contingent liability. There is this contingent consideration. So those things are not covered. 103 cover the contingent consideration. Construction contract or revenue from contract with the customer, including refund liability. There was a time where they used to book sales in 1 year and that team escaped performance issues. In big corporates, let us speak the reality of the profession now. They are under tremendous pressure to show performance. See, this is professional fraternity, closed circle, where I can share the thoughts with a lot of freedom. So big companies under pressure to show better performance. I am not conveying any negative message. It is like sometimes when there is leniency in standard, they tend to use that. In the past, we have seen a lot of instances where there will be huge sales in the last few months, and that will come as sales return in the first few months of the next year. I hope you get my message. Now 115 cutthroat. Right, 115 very clear. If there is certainty, right, if it is probable, then recognize revenue. If there is refund, in some of the cases, in some of the products, the return percentage by some of the e-commerce portal, the data available in public is more than 60%. Then imagine the kind of financial we are signing, honestly, right? Touch your heart and realize So if 60% possibility of return is there for your product, and when we handle those kind of things and we sign true and fair, imagine the kind of profit they report and the possibility of that profit. So what I'm trying to tell is there was situation where these returns were postponed. Now 115 plus that. And there is a wrong notion with respect to 115 that they discourage or there is no scope for percentage of completion. There is nothing like that. It all depends on contract. So contingent consideration, just now I said in another context. So then there are other things in 115, like the revenue, when you can recognize, all those are covered in 115. Now let us come to the core. What is provision? See how easy the definition is. Just one line. Very pleasant and very easy, right? It is a liability of uncertain timing or amount. Now I will tell you something very important here. The kind of linking words, it plays a very huge role. Specifically and are magnificent impact in our profession. Ind AS 2 would have been dealt with. Today, I would like to add just one point. How do we value inventory? It is cost dash NRV. Whichever is less. Fair value nowadays, NRV closest to substitute fair value. It is cost and not R. Today you refer, if you have a thought process R, you refer and. We can speak non-stop on that, half an hour, why they use and. That's not agenda today. So it is a liability of uncertain timing or amount. So anyone has to be uncertain. If both are uncertain, it is not provision. That will escape the definition. You see, that's the impact of and or. For a common person, it is okay. For professionals, they create huge difference. I will tell you now. It is a liability of and or amount. If I put if there is a case where liability is there, but amount uncertain, provision applicable. Timing uncertain, provision applicable. Both are uncertain, it is not provision. Within the definition of Ind AS 37, such huge things are there. So liability, you know, it is a present obligation which arises out of past events, the settlement of which require an outflow of resources embodying economic benefit. An outflow of resources. That's what is called liability. That's what is called liability. So present obligation, again we have various things here: present obligation, future obligation, past obligation, legal obligation, constructive obligation. That's all. It is all about obligations. So what is obligating event? The event that trigger the outflow of resources. We don't have any alternative settlement. I mean alternative mode of settlement without outflow of economic benefit. Such kind of things which trigger the obligating event. Old language, cost driver we used to call in our student days. So that is what is now obligating event in short. Then legal obligation can arise due to three reasons: by virtue of a contract, by virtue of a legislation, and other operations of law. For example, if there is a company which contaminated river, a company, chemical company located in the river bed, they contaminated land or river over the years, and there is no legislation in that particular state. Suddenly, state government, one state government, become very responsible with respect to environmental aspects, and they create a law which is certain to be enacted. Then the obligating event is contamination of land. They have to create provision. It will become legal obligation. Second example, there is one airline company. As per civil aviation norms, once in 3 years, they are supposed to overhaul the aircraft, complete overhauling. In shipping also, such a procedure is there. It is called dry docking. So they have to overhaul the complete aircraft. One company, let us say Fisher Airline, like that, they could not overhaul due to shortage of fund, whatever reason. Now, law cannot create legal obligation here. See, very important. Now, is there present obligation? You are finalizing the accounts for the year in which they should have done overhauling, but they did not do. it is as good as your tax audit due date violation. For that, we don't create provision for that penalty. I can list a number of other possibilities like this, where law is there, but we don't immediately create provision. Here, follow this point alone. This is the current scenario is what? They have not done any action. This entity has not done any action which trigger present obligation. They have not done overhauling. Suppose they have done the overhauling, the vendor did not send the bill, then provision. Then provision. They can, the present situation is for violation of this overhauling requirement, the airline is liable to pay penalty if there is any. And again, you cannot create provision for penalty automatically. Like I said, tax audit penalty. In all our professional practice, we would have come across the tax audit due date violation many occasions, but very rarely. I am speaking about till date situation. Future can differ. So till date, they levy penalty only in rare cases. Like that, it depends on stringency of enforcement regime. You cannot automatically create provision for the penalties, all that also. So ultimately here, there is no present obligation. When they finish the overhauling, different story. Merely because a provision exists in law, I cannot dump the P&L with that expense. So this is the power of next important point. I mean the present obligation, which arises due to legal obligation. Constructive obligation, the festival bonus is the easy example. Constructive obligation. It arises by an established pattern of past practice, published policies, right? As see, actually, this is the point I made earlier also. It creates valid expectations in the minds of counterparty. That is what is called constructive obligation. It is like some companies you would have seen, they distribute compliments during festivals like Diwali and all. So for all this, there is no legal requirement, but it is established past practice, and due to which it creates valid expectation in the minds of counterparty. So we have to create provision. So the next important aspect regarding provision, contingent liability, there are two things here. One is possible obligation. Second is present obligation. Possible obligation, chances of occurrence less than 50%. Less than 50%. And the occurrence again depend on one or more uncertain future events which are not wholly within the control of the enterprise. Litigation, pending litigation, easy example, before tribunal, high court, supreme court, whatever it is. And present obligation, on the contrary, also become contingent for some reason. One, it is not probable. Entity believe, the management should believe this. Entity, the management believe that it is not probable that outflow of resources embodying economic benefits will be required to settle the obligation. So then we are not able to measure. See, for provision basic requirement, I need amount. In simplest language, provision, you pass entry. Contingent liability, we give a footnote, matter over. That's all. And now contingent asset is a possible asset. This is what is brand new. Vis-a-vis AS 29. AS 29, we never discuss about disclosure of contingent asset. Now, contingent asset defined first. It arises from past events and the existence will be confirmed by occurrence or non-occurrence of one or more uncertain future events which are not wholly within the control of enterprise. Claims in favor of us. We lodged a claim on our supplier. We damage claim in the court, saying that because of their delayed order, delayed supply of goods, we lost one export order, like that. Few things alone we will discuss just to understand the points relating to the trade payable provisions. Trade payable is a liability. Trade payable is a liability. It is not a provision. All of us know. Provision require either in terms of timing. I compress the whole table and make it just in 2 lines. Either timing uncertain or amount uncertain means provision. Contingent liability. And in liability, everything is certain. In case of liability, timing certain, amount certain, everything certain. Contingent liability, right? It is a possible obligation, or it could be a present obligation, but outflow uncertain. or timing uncertain. You are not able to, I mean the amount uncertain, not timing, amount uncertain or outflow itself uncertain. Entity believe that they will not pay the claim, and provisions have to be reviewed every year. Very, very important. Sometimes what happens, it is a copy paste of annual report. Practical point I'm saying, copy paste. Due to that, some of the cases which are decided, right, this auditors only will know. Some of the cases against which either the order is passed either in favor of the company or against the company, but they are still there as contingent liability. Copy paste problem, not due to any technical issue. We have to be careful. You have to review. Second important point, provision created for one purpose cannot be used for another purpose. There is no offsetting mechanism. It has to be, see, because if you adjust one provision with another provision, we are suppressing two different line items. I mean, we are misstating two different line items. So that is another important point. Then three important requirements for provision. One, there should be present obligation, which may be due to legal or constructive obligation. There should be present obligation. Second, very, very important point is outflow, right? That outflow of resources should be probable. Probable means chances of occurrence more than 50%. I told you just now, probable chances of occurrence more than 50%. We have a slide called PPR analysis. In that, I will tell you all these points together. A reliable estimate can be made of the amount of obligation. So once these three conditions are satisfied, we create provision, we recognize provision. Past event lead to present obligation, right? Past events also lead to present obligation. So then there is constructive obligation. There is this constructive obligation or present obligation. Just few seconds, kindly excuse. So it could be due to that past event, but it is present obligation. That's what we consider for the present obligation exactly on the reporting date. That's how it is. And we recognize provision. This is what I said, PPR analysis. Our audit work or the finalization will revolve around this. All that you have to decide is just 4. If you decide just this 4, things would be much easy in the audit environment. Lot of discussions can be reduced also. In that sense, very positive. So it could be virtually certain. In that case, we have to recognize for contingent asset, this box will apply. I have given here as probability of more than 95%. In fact, there is an opinion, it should be 100%. Either way, 95 to 100 can be a rational approach. Then probability of more than 50% is what we call it as probable. Possible means less than 50%. I'll keep it like that. Remote, almost negligible chances of this particular occurrence. So basically, why we did not bring ECL, expected credit loss, within provision? There is a difference between present obligation and decrease in the value of asset. We cannot interchangeably use them. Lease covered in 116, but impairment in lease receivable covered in 109. Trade receivable, establishing trade receivable, contract receivable covered in 115, revenue recognition linked. But impairment in your trade receivable, that is not covered in 115 or 37. So asset related impairment, basic nature of provision for bad debt is asset related impairment. Basic nature of provision defined in accounting standards is obligation, liability to pay. We cannot interchange. I told you decommissioning liability we will recognize in year 0 as a component. Through unwinding, we will reach the ultimate outflow required. Like that it is. So provision, it is outflow of resources embodying economic benefit. That is the recognition test. Probable, I told you, chances of, I compress the entire points as chances of occurrence more than 50%. Then if there is reliable estimate, then only it is possible to recognize provision. Then an entity shall not recognize contingent asset. The moment it becomes certain, it is no longer contingent asset, then we can recognize that. Look at this very important point. This is where again the arguments between audit team and the accounts team starts. Recognize. If realization of income is virtually certain, right? The asset and related income are not contingent, and we have to recognize them. Otherwise, it will continue as a contingent asset. Contingent asset is a claim made by us on our counterparty. I told one easy example, claim made by us on the vendor. So it should be best estimate. So management judgment involved, very, very important, discounting required. And it is without tax effect. We cannot consider the tax effect, and that will lead to other issues, you know. So without tax effect, it is present value measurement. Just now I said discounting required, and through unwinding of interest, we will reach the ultimate amount. In fact, one of the forums, when I was saying this, one senior member was asking this doubt. Very often you are referring this unwinding of interest, unwinding of interest. What is this? Now also we refer that. I will make it very simple, few minutes only, because this provision also requires that. Your liability to pay decommissioning cost, restoration of seabed, whatever, these kind of examples are annexed in this Ind AS. You have to incur that expenditure, actual outflow required in 10th year end, 20th year end, like that. How can I account that amount in absolute terms? That is what we were doing all these years in accounting standards. But speak reality today, we as CAs, we know the present value is never equal to that absolute amount which you are going to pay 5 years later, 10 years later. So I have to discount, arrive at the present value. Today I account the present value. Assume it is PPE or intangible asset. One of the components decommissioning. I told you entry PPE to provision for decommissioning. We created. Assume the actual outflow 100 crores. Present value today 53 crores. Now on payment date, with 53 crore provision, how will I meet my obligation to pay 100 crores? So what you should do? Build up your 100 crores. For that, your class work, probably you would have done it in CA final those days. Present value factor. Nowadays, software is there, don't worry. Software will tell you what is the interest element. And using our old CA final mechanism, I would say, the present values you can establish. And for this, you have to go by prevailing market rate. Two things are there. One is how to establish this rate. Next problem. Today, I will give you one easy solution, not suitable for all occasions, one occasion. Some, or I can say some occasions. You can nowadays, the banks give something called offer rate, offer letter. You discuss with your top official of your bank, they will give you offer letter. Quoting the terms and conditions, they will give this. Using that offer letter, we will be able to get incremental borrowing rate. One of the tools to assess your market rate. Because discounting, I tell at what rate? Market rate, in a meeting like this, telling it is easy. You have to search a lot of industry publications. If that is not suitable, next best remedy, if your company is operating with borrowed fund, get one offer letter, preserve it as a documentary evidence for your market rate. So that is a big proof for your incremental borrowing rate, which every banker now giving even for small loans. And why corporates get this offer letter? Some of you may be knowing the trick already. They will show that to another banker and negotiate. Reality. So these tools can be used to determine your discount rate. So I will reach from 53 and odd crores to 100 crores through another entry, finance cost account debit to provision for decommissioning liability. Through that, I can reach that 100 crore. So that outflow facilitated, thereafter nothing to book. And now we will speak the accurate accounting little more. 100 crore I am going to incur 10th year, 20th year, whatever it is. Today, what I account the present value, accurate accounting, step 1. Step 2, there are 2 elements in your 100 crore. Today itself, I commit in terms of present value. Anything I commit today, it is always present value. And I am going to pay this on a future day. So 2 elements, interest. Basic example, even in inventory, it is applicable. When you ask for a cash price basis, they will give one price. Deferred credit, deferred settlement, another basis. And the difference between the two is interest cost undoubtedly. Any trade, you ask the product price, cash basis, they'll give one price. Credit basis, price will be more. Your past experience will substantiate this point. When the price is more, what happens? Automatically, the difference is due to interest element, which we are technically recognizing. I am not saying if 120 is credit price, 100 is cash price, life is not so easy. Take the difference, 20, book it as interest. Things are not so easy. You have to go scientifically based on present value factors. I will tell you only one more step. The present value difference between year 1, year 2. That's what is your finance cost. That's what is unwinding of interest. In simplest language, reaching 100 crore from 53 crore is unwinding of interest. That's all. So all of you would have come across this in financial instrument standard. I'm only elaborating on that. It will facilitate the understanding of many. Then the future event. Right, future event may or may not affect your present obligation. Another very important point. I said onerous contract, but we never recognize future operating loss. Why? Because that can be avoided by your future action. Even in that airline example, which I said, they can avoid this entire obligation by transferring the aircraft with that particular deficiency. There may be a buyer ready to buy. They'll say, once in 3 years, we have to complete the overhauling. We have not done. Because of that, you reduce your price. Some of us would have sold our car, old car, due to a number of reasons. When your tire is due for, due for replacement, what we will tell to our buyer? Anyway, it has to be replaced immediately. I'm a God-fearing person. You reduce your price. Same logic I'm telling now. They can transfer the airline business, or they can sell the aircraft, by which the obligations would never come to the entity. And that's why we never recognize future operating loss. First of all, what provision we will make? It's not possible. And contract related foreseeable loss is there. That is covered in 115, civil construction and all. The related foreseeable loss, 115, this standard not applicable. There we recognize because it is onerous. It is onerous. If the expected benefits, the cost is going to exceed the expected economic benefit, irrespective of stage of completion, irrespective of the profits expected from other contracts, irrespective of, last most important, whether or not we have commenced the contract. You have to recognize, see how certain things are. And why? Because both parties are bound by contractual arrangement. There is a legal obligation to perform. If it slips into executory, 115 will apply. If it slips into onerous contract, then this standard will apply. Executory contract, presently the scope more or less come in 115, like that. Then if there is a reimbursement, suppose there is a public sector advisory company. They operate on a cost plus model. They always operate on cost plus model. They bill their customers based on the hours spent, like our big 4 audit firms. They bill the clients based on hours spent, all that, including email reading. See, you know all this. Like that, they bill the customers based on the hours spent. It is a software advisory company, assume like that, PSU. Now, what can happen if there is a wage revision set up by the management under the leadership of a retired judge? That is how it is. And the wage revision committee recommends some 320 crore retrospective increase. It is for arrears and all. Whether you cover it under 19 or this standard, that is separate because of other technical aspects. Now, last point, I'm going to make something significant. You will not recognize provision. Some of you will wonder, what is this? Now the wage revision committee recommend, or they tabled the report saying that you have to increase retrospectively for the past so many years, increase. This entity obligated, keyword is cost plus contract. See, whatever you work as cost plus contract, completely reimbursable. If there is a dispute on that, then only we should think of other things. Just because it is cost plus, you cannot recognize the asset automatically, receivable. See, what is cost plus model? The cost I incur as a service provider, I should get back along with your fees for services. That fees may be a fixed percentage. It may be a fixed percentage, or it may be a fixed amount, fixed percentage on cost or fixed amount. So if I incur cost, my customer should refund that. My customer should pay back. That's what is cost plus model. So it is entirely receivable. If I book provision, I'm overstating expenses. If I book only provision, overstating expenses. So possible reimbursement should be considered only when there is virtual certainty. Suppose your contract is not clear about this kind of revision, then problem. This can be decided only by professionals, and this cannot be decided by outsider. Only you have to conclude based on contractual terms. Is there virtual certainty? You are the authority. So otherwise, what is the safe bet always? Management, how can you bind them through resolution? Second, a commitment, a communication from the customer, that is more safe. One, the communication first should originate from management. Documentary evidence today very important. Apart from learning Ind AS, that is what is indirectly explained here about virtual certainty. Look at this. This is what I said just now, quoting an example. Examples make us to understand very easily. Expense relating to a provision may be presented net of recognition for reimbursement. Just now I said no provision on a cost plus model, because cost plus model invariably provide for reimbursement of all the costs we incurred on the contract. That's what I said. So after that, change in provision. It is something routine in big finalizations, you know that. Review of provision at the end of each period. It could be interim period or annual period, each period, so that we reflect the current best estimate. The difference can be charged or reversed. When we have to reverse, when it is no longer probable that outflow of resources embodying economic benefits will be required to settle, then reverse. Increase in provision, just now I said as unwinding of interest, that is your borrowing cost. I said one entry also, finance cost account debit to provision for decommissioning liability. Now this provision you can revise based on change in interest rate, based on commitment change and other things, because everything is estimate. So it is bound for revision. I hope you understand. Provision for warranties, another live point which will get covered in this particular standard. And again, what are we going to decide? Is there present obligation? On warranty claims already received, no need for any estimate. I mean, I am talking about some other estimate. I am talking about defective estimate. Defective estimate you and I cannot make, only technical team can give to us. Defective, suppose our product, we are a motor vehicle manufacturer. Our product has a track record of 10% defect. That will come as contingent liability. Contingent liability. Warranty claim already received. There is a old costing concept, many of you may be knowing, bill of material. What bills we charge, they will add that, and the concerned service team will be able to tell you the best estimate. For the warranty claim already received, provision on that, there is no question of the contingent liability and all. Suppose there is a reimbursement from our motor, in our vehicle segment, motor alone outsourced, motor manufacturing. So for the motor, there is this reimbursement. Consider that. If the defect is in the motor, how much percentage, all this should be factored in creating our provision, including borrowing cost. Then future operating losses, I discussed this already. We don't recognize because future uncertain, all that. And they don't meet the recognition criteria. Then there is this restructuring. We will discuss that. Restructuring changes the very nature of business. The scope of business itself changed. the way in which business conducted, that change. For example, if a company's manufacturing process shift from manual conveyor, you would have heard this nowadays, very rare. Manual conveyor belt used to be there where human intervention will be there, to automated conveyor. Conveyor belt, you know, the output carried in conveyor. Then that could be restructuring because of increase in volume of output or the scope of the work they do, like that. So it could be sale or termination, which happen in a demerger. Our capital gains language, slum sale. One division, a company doing paper business, cement business, they sell only paper business. That is called demerger. AS, there is no discussion at all about demerger. AS, there is no discussion about unwinding of interest at all, except accounting standard 10, property, plant and equipment. AS, Ind AS, both are same. But Ind AS, this demerger related discussion is there. That is restructuring because we want to focus on paper business. So we hive off our cement business. That is restructuring. Closure of business location, change in management structure. We infuse the foreign management, something like that. So for all this, there should be a formal plan, and the company should have announced this formal plan in a sufficiently specific manner. Announced means to authorities so that they cannot go back. The certainty of the restructuring exists. And based on all that, we create provision for restructuring related cost also. So here some important points. No obligation arise for sale of an operation until there is a binding sale agreement. Sale agreement itself binding, right? Why they use this word, binding sale agreement? And in fact, the standards will say it is announced in a sufficiently specific manner. Certainty itself 100%. Why they say virtually certain? If you look at the background of all this, very interesting. There should not be rollback. One day they say restructuring, next day they roll back. This you can decide based on the management's past behavior, which auditors will know better through documentary evidence. So, if the obligation, if there is no obligation, right, then we cannot consider it as a restructuring. A restructuring shall include only direct expenditure and shall be necessarily entailed by the restructuring, not associated with ongoing activity. If it is associated with any ongoing activity, we cannot categorize this as restructuring. Thin line of difference is there between the discontinued operation and this one, right? So discontinued operation related points, if you look at this, more or less it will resemble that, but that is slightly different. For want of time, I'll skip that. Then provision, almost a reconciliation we present. Provision at the beginning, provision at the end. What is the increase? What is the decrease? Your increase due to change in amount of provision or due to finance cost. Decrease due to partial outflow. All these have to be presented. It's not one line item which we have to present. Everything. And contingent liability, you have to give a description, how it has come, why it is contingent. Because there are two clauses here. Possible obligation, which may arise due to future related uncertain events. Present obligation, there is obligation today. Two categories of contingency. One category, possible obligation, which is depending upon one or more uncertain future events, which are not wholly within the control of enterprise, entity here, entity. Then the other one, present obligation is there, but we don't recognize for two reasons. Management believe that there will not be any outflow of resources embodying economic benefit. In short, that's a frivolous case. We need not pay, that kind of belief. Second point, second important point. It is not possible to estimate. Our legal experts are divided. Legal team, we send it for legal opinion. They are divided and a lot of confusion. Then it is contingent liability. Because court cases, you know, one tribunal will give for, another tribunal against. Very common in our profession with respect to income tax cases. And because of that, what happens? In a large environment where 100 crore, 200 crore provision we have to decide, it will have a serious impact. And there will be debate between audit team and board sometimes. Because audit committee, to some extent, they try to convince auditors. If things go out of their hands, whole board sit. We have encountered one such situation. I said I will share. So I'll summarize the case. It is a big case actually. The company's past practice, actually it is not squarely within this standard, but the concept of provision applicable. That's all. It is not entirely within this standard. The company used to have a past practice of providing for non-moving or slow-moving item. They have a practice. They only developed this accounting policy. It is a pharmaceutical company, parent company, Chennai-based company, listed company. Subsidiary outside India. I will stop there. Outside India, because I should not narrate country, all that. That's why. Outside India. Now what happens is, fag end of March, they transfer, the stock is going to become non-moving by March end, almost 15th of March, like that. In about February, they transfer this to their subsidiary company. You know what is what. Beyond this, I need not tell. It is booked as a sale. They tell statutory reason because it is customs export, all other points. It is booked as a sale. Goods move outside India. Now, what will you do? Will you create provision for this? Not in this standard. I already told. See the ticklish issue. Now, holding company, parent company booked profit. Goods move outside the country. Now, legal entity concept, if you go by that, which all of you, I mean, would have mastered in your basic stages, this is a separate entity, that is a separate entity. This is the Indian standard view. Global standards are very different. Substance is given cutthroat importance. Substance. Where is this functional currency in your Indian accounting standard? See, you are discussing only two currencies in our existing standards. One is foreign currency, reporting currency, nothing beyond that. Look at Ind AS. You have functional currency, third new currency, where the country of primary economic environment. Like that, we give enormous importance to substance. I will tell you example. Company registered in India. They are having all their operations in Sudan. They do the oil pipeline contract in Sudan. All their negotiations are in US dollar, not in Sudan currency. Then US dollar will become their functional currency. Things are very different. The primary economic environment, how to decide that? For that, there are factors. So like that, here we give enormous importance to substance. 115 is the exact standard. Here there is uncertainty. Why? With the short expiry, due to the control the parent entity has, of course, several crore impact. Almost some 20 plus crores impact. Profit impact itself is close to 3 to 4 crores. So we concluded provision has to be made only in parent company, nothing doing. Goods should have gone there. Now, there is an escape route here actually. If the subsidiary sold to outsider, different story. At least the substance concept, it goes out of the domain of combined entity. See, for your 110 consolidation, what you consider as entity, group, what is the group? Parent, subsidiary, everybody. Otherwise, standalone effect may differ. For consolidation, you require provision. Our view was slightly different. Standalone also, separate financial statement, also provision required. Because today, if there is a likelihood of refund itself, I cannot recognize revenue. I cannot recognize. If there are 50 computers sold, and out of past experience, we have a track record of 10 computers getting returned. If there is a cashback offer, I mean, if the product doesn't perform according to their satisfaction, when they return, present requirement, I cannot recognize revenue on 50 computers. Those days have gone. And today, your key requirement is performance obligation. Another obligation I introduced now, right? Legal, constructive, performance. Next. If a mobile selling company like Apple and all, a mobile vendor, they promise sale of mobile along with SIM card activation free. And one foreign national buys some 10 mobiles. Mobile sold, cash received. But if SIM card activation pending, revenue cannot be recognized. Impact of combined contract. Impact of combined contract. Separate the contract otherwise. Separate. SIM card activation, separate service. Your sale of mobile, separate service. Your contract. That is why the revenue standard as well as provision more effect due to the contract. Then the effect of uncertainties. And with respect to contingent liability, we disclose uncertainties. And if there is a possibility of reimbursement, we just disclose. That's all. And contingent asset, whether that inflow is probable, we have to say. Why? Because if you believe that inflow is probable, then we should recognize. That becomes your receivable asset. It is no longer contingent. So I told all this, so I skipped this. I mean, increase, decrease, additional provision. I said, like, you cannot net off one provision for another provision because it suppresses two different economic events. So when we talk about deferred tax asset related impairment, Ind AS 12 cover. This standard don't cover. Ind AS 12. So like that, impairment related, that's the clue. Impairment, if there is a impairment on my receivable, separate standards are there. Other liability standards separate, those are not governed here. Impairment standards, you have NRV less than the cost of your inventory. We have to write off, but that is not covered here. Ind AS 2. Ind AS 2. And there is reversal in that write-off. I mean, your opening stock also include that product. We have written off to NRV. During the current year, there is increase. The same goods remain as closing stock. There is improvement in your NRV. Old standard silent. But result would be same. Because you go by what? Cost and NRV. Cost is going to be permanent once you incur. Where is the change? So that is why old AS2 also same effect. But Ind AS2 provide for reversal. You have to reverse. And that reversal should be separately presented. Your reversal cannot exceed original write-off. This much not in this standard, in Ind AS2. So if there are separate standards, go by that. I gave you two macro clues. If it is impairment, if a sort of write-off is different, obligation different. Because there are a lot of debates in practical. One person says, if provision standard is applicable, not applicable, why they call it as provision for bad debt? See, this kind of argument. Name different, definition different. Like that, probable means somebody say dictionary meaning different. We are not here to analyze dictionary meaning. I told clearly, probable chances of occurrence more than 50%. Possible less than 50%. Remote, negligible chance. Remote means contingent liability. Possible, contingent liability. Probable, provision. That's all. So like that, you can have a simplified understanding. So then we will go to another standard. I think we can have the question answer session thereafter. Sir Gopalakrishnan sir, can I proceed with one more standard is there for another few minutes at least? Can we move on to Ind AS 40, sir?
Yes, sir.
Sir,
Yes, sir.
one doubt, sir.
Yes,
Yes, sir. Good morning, sir. One doubt. See, one of the disputes that we have had with our auditors is TDS for provisions made in the financial year end. Now, there are a lot of provisions which we estimate, and there is a call that we did not deduct TDS because we don't know the certainty of the amount and the certainty of the event. So in this case, how should we move forward, sir, about TDS on these provisions?
I understand your viewpoint. TDS is decided based on income tax provision. Accounting principles never talk about this, honestly. It is our income tax. At best, deferred tax asset, there are some points. So your TDS obligation itself is decided by Income Tax Act. Many of the provisions of Income Tax Act, if you refer, they don't wait for incurring of expenditure as per accounts. Even ICDS for that matter. They will tilt towards payment, if you see. Because that is the main reason we introduced deferred tax asset liability. For income tax alone, I cannot jump from accrual, go to cash basis. That is the reason you are monitoring through Ind AS 12. The cushion effect, accrual, your target is accounts-based tax is permanent. That's what is the thesis behind your deferred tax. So like that here, the thesis behind your tax provisions will decide the course of correctness. I mean, if tax provision says TDS, even if it is disputed, if TDS applicable, you have to deduct. But now safe bet, deduction is better. And
Okay,
accounts you can create, and at best it could lead to some interest kind of things. In a dispute scenario, what is advisable is better to go with the TDS, because suppose if dispute settled, we will deduct TDS in the next period. Income tax, there is always this issue of disallowance, and you may book part of those expenses in the previous period itself. All these issues. That's why it is better to account the TDS payer, irrespective of TDS return. I mean, TDS return should accompany this accounting. That way, going by the respective provision, that would be better. So if the provisions endorse the viewpoint of payable or credit of the account, that is how most of the provisions are. Most of the TDS provisions are. Your payable or the credit, whichever occur earlier, you are supposed to deduct TDS. That's the viewpoint.
Thank you, sir.
Thank you. So let's continue with Ind AS 40. Very easy from a practical point of view as well as academic side. Very easy standard. We can feel very happy. One line item in accounting standard 13 became one standard now. Land and building, when you purchase for your entity, for your company, which accounting standard applicable? Can you tell? Now don't tell 40 because we are in 40. See, I told provision for bad debt. If you say provision standard, it would become a wrong answer. Like that, land and building purchased by a company. Which accounting? I mean, Ind AS. In my language today, accounting standard, Ind AS. Which Ind AS applicable? Let us go to that. One answer has come quickly. Ind AS 16, good, nice. PPE, very nice. PPE, very good, very good. Any other standard? Proceed. Just participate, because so that it doesn't become one-way communication. Okay. Some answers I got. Very good. See, Arun Kumar become diplomat. He says, provided intention. Very good. Intention, depending on intention. Intention is important. Ind AS 16 if for business, otherwise it is investment. Very good. Now I'll tell you connected standards now. Ind AS 16 applicable when we buy that for production, business purpose in short, or rendering of services are used by others for rental and all. Then we do it as a business rental income. Then 16. When we buy that for capital appreciation, you buy land and building, shell company model, today very popular in our profession, right? Shell company. What is this? Without operations, they are having some properties, good or bad reason. Because the moment I say shell company, there is a thought process, black money. See, somehow these are interlinked, right or wrong. So it is entirely that model. I mean, we buy investment property for capital appreciation or rental or for both, then it fit into this standard. Now, initial recognition of your PPE, you would have come across already at cost. Even if the company plans to adopt revaluation model, our initial recognition shall be at cost only. This is a prerequisite. Here also cost model, most important. Here the standard prohibit adoption of fair value model, which we used to call revaluation model in the context of Ind AS 16. Here fair valuation model not applicable, but they can disclose fair value. If you see some of the leading companies, Godrej Properties, and there are other leading property companies, you see their balance sheet. Today you can refer 5 minutes of your time, just 5 minutes. You refer, there is one park like that, one company. All this, if you refer, they will disclose the fair value of property, but they won't take it to their balance sheet, because huge unrealized profit will sit in one of the companies. That because of time constraint, I'm not able to show the balance sheet. In the balance sheet, it was less than 1,90,000 and odd million. Fair value 2,83,000 million. Very true. Today property values are very high. You all know. Had they brought it to the balance sheet proportion itself will change. And that balance sheet total size itself was 2 lakh million. So why I highlight this? It is unrealized profit, but we know how to bring market value to book. If somebody requests a management person, you know how to bring market value to book. Revaluation, if permitted, revaluation model. But here it is prohibited. It's not permitted. So we will also discuss the recognition principle, derecognition principle, disposal, all that. As usual, first objective, the purpose of knowing the objective so that our thinking will be streamlined. It prescribes accounting treatment only for investment property and related disclosure. AS, you had only one line for this. AS 13 deal with this. Ind AS, you have one standard considering importance globally. And one immediate clue, this was asked in another forum, that's why I'm sharing. In this world, sir, can you tell one property for which value will decrease? They talk about land. I immediately said, no difficulty. Kabul. If the entity's property located in places like Kabul, I have other lists. See, I don't want to share. It should not become a conflict of countries. So there are places where the value decrease year after year. Value decrease year after year. So both are possible. That alone. Here we reflect only cost. We don't deviate from that model. Depreciation applicable for investment property, for building component alone. On land, there is no depreciation. Am I right? Yes, sir. On land, whether depreciation applicable or not applicable. Respond. Some query has come. All of you, even though so many times. Okay, that is regarding link. I will ensure that it is sent to you, the materials. Now I was talking to you on the depreciation on land. Normal person can say depreciation not applicable. As CAs, we have to be cautious, and enough of cautiousness after the new ethics. Anything you tell, even in public domain, you know how sensitive it has to be. Otherwise, they will create sensitive problem. If one student drafted this nice message, how many balls per over? Had it been an ordinary student, 6 balls, answer closed. For a CS student, she wrote a nice para. If there is no rain, if there is no ball, with all this condition, only 6 ball, right? Like that, we have to be conditional. On land, no depreciation unless it has limited useful life. This is how it is categorized. When it can have limited useful life, leasehold land. We have 2 types of properties, freehold, leasehold. On leasehold land, there is a possibility of depreciation. I never said you have to depreciate, possibility. Why? I said there is a possibility. Leasehold land, most of the time they capitalize along with the land and building. It is automatically depreciated as building, whether right or wrong. Actually, they have different useful life. Your lease can be 99 years, but building life can be 30 years. How can I club? This is how it is. They club both. This is one audit point. Land should be separate. Equity component should be separate. Your OCI components, you have a checklist. Today, if any company reports something as extraordinary item, gross error, as per Ind AS, there is nothing called extraordinary. You will say earthquake loss, world standards. No, it is not extraordinary. You will say insurance claim, which I never got in the past. They will say it is not extraordinary, extreme. We acquire another business. In that you get gain. I didn't use the word profit, gain, capital gain, global standard. Take it to P&L. It is not extraordinary. We took a carve out. We felt it dangerous. So India, we took a carve out. We said, let it go to capital reserve, gain on bargain purchase. I said demerger today. And we buy a division. On that, we get a capital gain. That should go to gain on bargain purchase. New name, old language, capital reserve. You all would have done it in amalgamation class of academic side. At that time, you would have learned it as capital reserve. That is called, now the account itself narrates this beautifully. Gain on bargain purchase. We bargain, and through that we get gain. So like that here, this standard deals with the presentation regarding measurement and disclosure. If investment, the of investment property, it could be owner occupied, it could be lease under a finance lease. Nowadays, operating lease, financial lease, there was a big difference earlier. The difference was, for operating lease, we never recognized the asset in the books of lessee. This was our traditional treatment, accounting standard 19. Now, Ind AS 116 very clear. Why the matter came, why I tell the background stories, so that you remember the provision clearly. There were a lot of airline companies globally. They were all operating on the operating lease model. They were operating on, they did not own the aircraft. They took it on operating lease. You look at some of the airline balance sheets, there was no aircraft, but they were airlines. They were in airlines business. Then globally, the thought process started. Then they inquired why no aircraft. They said everything is operating lease, previous requirement, Ind AS 17 and now not applicable. That's why I always stop myself from quoting those standards which are not there. So now Ind AS 116 made it very clear, you have to disclose in the books of lessee. Of course, there are practical expedients in every standard. If things are, if you are unwinding of interest, if you settle within 1 year, no need to recognize unwinding of interest. And we discuss so much about unwinding of interest because every standard has implication. You take employee loan given for a long-term period, 5 years. Traditional system, at best, what will you account? You will debit employee loan, credit bank. Matter over. In the year of recovery, if it is interest, you will take the interest to the credit of P&L because income and reduce the principal portion, close the chapter. Suppose company gives the loan at 4% rate of interest when the prevailing market rate is 10%. Is it logical? Is it accounting? Undoubtedly, they get a perquisite of 6%, and you cannot fine tune the answer as just 6% because outstandings change. When outstandings change, what happens? The interest proportion change. Now, what is the requirement? Recognize the interest based on market rate, 10%, and book your recovery, fine tune, arrive at the fair value as what? Present value of your total recovery. You call it by whatever name, coupon interest, principal recovery, whatever your name, we call it by one name, contractual cash flow, matter over. Go by inflow, outflow, arrive at the present value, book that as your financial asset. Recognize 10% interest, we would not have received. And book the remaining 6%. 6% is a rough number. I told you, outstandings differ, calculations differ, but very easy. In half an hour, you can understand with your existing knowledge. In half an hour, you can understand the mechanism of present value discounting, not even half an hour for many of you. So we will recognize that difference as cost, today's requirement. Like that here in Ind AS 40, we go by substance. Had it been our traditional accounting, if you give a security deposit, rental advance, there are two models. Some cities, they call it lease. Actually, not 116 lease. There are two models of rental. One model, you deposit a fixed amount. Second model, deposit a fixed amount, pay monthly rental. If it is first model, imagine our old entry, which we all would have seen in our articleship days. Rent advance account debit or security deposit account debit to bank on the date of payment, on the date of recovery. Now what you will do? Bank account debit to security deposit. Feel happy, enjoy life. Now, you have to account the present value of what is receivable by you only as rental advance or security deposit. Remaining has to be booked as expense. Actually, what is the idea? The interest on the deposit is a contra effect for your rent. That is the old idea with which this practice started. At least it is prevailing in Chennai more than other places, other cities. Somebody will deposit some 70 lakhs and take the premises for 5 years. At the time of vacating, the landlord will give back 70 lakhs. It's a common practice in Chennai. Presently, Ind AS require you to unwind, arrive at the present value of your recovery, 5th year, and book it as rental advance or security deposit, as the case may be. Remaining has to be treated as expense, and you have to book interest. He was asking TDS. At least that is okay, dispute only. Here, interest itself you will not recover. TDS issues may come based on assessment, based on financial statement. But there is a mechanism, don't worry. There is a FAQ model with which Ind AS companies are tackled in income tax. I avoid income tax discussion. Then the whole subject will discuss as tilt as tax. So it could be under any of these three models. And here also depreciation applicable for all these three models. Then what is carrying amount in simplest language? WDV. WDV is your carrying amount. Cost, the amount of cash and cash equivalents paid or fair value of consideration. That is what is cost. Fair value, here new definition, different definition. because general definition of fair value in other standards differ. Kindly notice that. Here it is the amount for which an asset could be exchanged between knowledgeable and willing parties in an arm's length transaction. So the other fair value in 113 and all, if you read it, the definition is slightly different for fair value. They will say the amount that would be realized on sale of asset, right? Not on purchase of asset. Look at the key difference. So it would be going to give a meaning that it is exit value. This is as per 113. This definition different. So then investment property, it could be any of this land and building. It is a property held for rental, capital appreciation, or for both. So it could be land, building, or your UDS model, undivided share model, land and building, rather than for use in production or supply of goods or services or for admin purpose. Then it is coming under Ind AS 16. Sale in the ordinary course of business, that will come under Ind AS 2. That's why I was asking this, but I did not answer the second part. I mean, when land and building bought, which accounting standard applicable, which Ind AS applicable? Ideal Ind AS 16, no doubt. But there are other standards like 40, Ind AS 2, when it is Ind AS 2, when it is the nature of business, then it become inventory. Like furniture dealer, for them, furniture inventory. For a software company, furniture become asset, like that. Ind AS 41 also, to a least extent, because agriculture, that standard, we India agricultural country, first time we have a standard, at least in Ind AS 41. But that standards are different. We cannot take it for granted. Fair value measurement based recognition, totally. And if it is for agricultural purpose, 41 also may have impact, like that. Then owner occupied property and investment. Owner occupied, as per this standard, it is property held by the owner or by lessee under finance lease for use in production or supply of goods or service. That's what we call it as Ind AS 16, PP. If a portion of building is held for earning rent, 1 floor out of 4 floors, then proportionately you should classify. Suppose you have 4 floors, in that 3 floors you use for your providing of service. 1 floor we use for complete let out. Proportionately you can classify that as investment property. There are other points here which I would like to highlight. There are other points. A few seconds, I'll just connect to a charger due to the battery requirement, just few seconds. So the portion of investment will be classified as investment property. Now, another point I said, there are other standards which may apply. Now, between finance lease, operating lease, there is a difference. Finance lease lead to transfer of ownership at the end of lease term. Because of substance over form principle, the lessee recognize lease at the inception as an asset and liability at the inception based on fair value of leased asset. Now, what is substance? What is form here? Form, lease, substance, credit purchase. See how it can be simplified. I can make it complicated also. First, let us have thorough understanding and then get into that zone. Now, why I am saying this particular operating lease, finance lease, because of substance over form, we recognize asset and liability at the inception. I told substance is lease, form is lease, substance is credit purchase. Only in credit purchase you recognize asset and liability. When do you recognize asset as well as liability? If it is cash purchase, you will debit asset, credit bank. Credit purchase, asset to vendor. That is what you are doing in lease, finance lease. Now, operating lease also, ROU asset should be recognized. This is the current situation. So, if your investment property is taken on a lease basis, then 116 will apply. This standard will not apply. I hope you understand. Because of the terms given in 116. Because of that. And for land lease also 116 applicable now. Now things change. If you are a AS based candidate, in your classrooms you studied AS, different understanding you will have. Present situation only I am telling. Then if the property is acquired for development and resale, property developer, then Ind AS 2 will apply. This standard will not apply. Then there is another category, continuation of something called a discontinuing operation or discontinued operation. If it is a property, plant and equipment held for disposal, we have a separate standard, non-current asset held for sale, 105 applicable. One person asked, sir, what is so special about 105? Another heading. See, we cannot take things like that always. I told today the impact of preference share. Calling it as debt, fine. Then you have to account totally different basis. Based on IRR, you have to account. Effective interest, it is called. Like that, here how you account, the moment you say non-current asset held for sale, it will shift its place to current asset. Imagine how balance sheet will look like. PPE we are bringing under current asset. Some of you will say, okay, what is the problem? One line below. Not only that, depreciation will cease. You cannot provide depreciation. When PPE reclassified, all connected to investment property. So when we hold it for sale within 12 months, then we reclassify that as non-current asset held for sale, 105 provisions applicable. So based on the nature, you have to identify standard. Suppose we are having a property, a third party do a property development in our property. Third party, property developer. Then 115 will apply. Contract, it become a contract. You cannot apply. And suppose we are holding it as investment property, but enter into this kind of arrangement, you have to reclassify. You have to reclassify that. It is the old practice. Many of us would have learned in our income tax classes, PGBP, profits and gains of business or profession. If somebody having land, introduce that land to their business, how you account it? That same mechanism. We will reclassify. You will in fact find the capital gains and the appropriate guideline value. At that value, we will bring it as an asset to the business. That is in a small scale. This is a large scale. That's the difference. Here it is interplay between standards. That's all. And last, very important. We bought land, but currently undetermined use. We are not sure what we are going to do, and we will decide at appropriate time. Then Ind AS party, investment property. So based on what for land and building bought, application of standards can differ. Suppose a company having PPE, they want to shift their property from industrial use to business use. 113 also applicable, fair value standard. There is this short acronym, right? POMM we used to call 113. Principal or most advantageous market. Principal or most advantageous. That is the principle we use there. Valuation different. Suppose the land and building, land is located in industrial area and you require 12 departmental approval to convert it as a residential land. Different story. You cannot close your eyes, go by Ind AS party, not possible. Different standards I say. 113 also applicable. 113. The most advantageous market you should consider, and you should consider the fair value based on its best available use. Lot of points are there, 130. Fair value standard applicable. So all this is going to be depending on the objective of original acquisition. If you cannot decide, indecisive, management clueless, they just say we had surplus fund, we bought. Then indirect message, it is for capital appreciation. Now, when we have to recognize PPE as an asset, current generation standards will use this word, if and only if, when and only when. These languages are repeated very frequently. When and only when we feel happy. See, because they pinpoint, and only if those things are satisfied, you can recognize. I will tell you 3 standards, 4 standards you will be benefited minimum now by knowing these 2 points, which are very easy. One is, it is probable that economic benefits associated with the asset, with the property, will flow to the entity. Probable. 1. 2. The cost of property can be measured reliably. If you cannot measure, where is the question of recognition? Now, toll road, a company take toll contract. They build toll road. Malaysian company take a tender and they build a toll road between 2 cities. All of you know that. And they spend on steel, cement, brick, bitumen, all the ingredients required for road. Where will you debit all this? Now it is whose road? In India, we have already enough of issues, right? So if there is a toll road, it is whose road basically? Toll road.
The National Highway Authority of India is owning
They
it.
don't, in short, government road. So what is the account I can debit?
No, it is investment property only because you are not the owner of the asset, and
Okay.
you have to take it as investment property only.
Okay, one view, we have to take it to investment property. Very great. Then any other view, you can participate through voice. It is easy. It is taken on lease. Somebody said Anand Verma, very nice. Intangible asset. That's the answer. Intangible asset. Now follow the reason. We don't have any right over the road. Very important. It's government's road. Let it be any department. Government's road. And already we have enough of problem. If a Malaysian company come to India and then say it is our road, imagine, unimaginable, right? So already we have enough of issues. So we cannot be considered as company road. It's government's road. And what right we get by spending on all this? We get a right to collect toll charge. Then it is intangible. Now, Ind AS view, there is a second possibility. You have to consider it as a financial asset. When government promise a fixed amount, Ind AS 115 applicable. One scenario, see how much of changes in viewpoints. Today things are very different. We never introduce any complexity in Ind AS. Don't have that view. If there is a view like that, kindly avoid that. We never introduce any sort of complication. All the business complications, we are sitting and providing solution today. That's all. And can you believe, in the front row of supermarket, to display some products, the seller paying money to the supermarket owner. Seller paying consideration. So today the mechanisms are different. And accordingly, old rule, sale means buyer will pay the price. Even that basic is changing today. That basic is changing. Seller paying consideration. How to account? Cashback offer. So things are changing. Accordingly, I told 2 possibilities. One is it would be a financial asset. When it would be a financial asset? When government promise a lump sum payment. If government says we will give you a lump sum consideration, then what will happen is it is a financial asset. It is not intangible asset. If it is open-ended, it is a revenue collection in the form of toll charge. It has to be classified as intangible asset. Because through all these expenses, what right we get? We get a right to collect toll charge from the users of road. I don't have any control over the asset called road. I cannot call it as my asset. I cannot sublease. Informally, different story. Formally, it cannot be a sublease. Formally, it cannot be a some other mechanism of usage. What is your role? You build the road, maintain the road, collect toll charge. Matter over. It could be either financial asset. When if government promise a minimum consideration of 250 crore for the road, government says we will give you that is government guarantee, financial asset. You have to recognize it as a receivable. Now another dimension. There are two elements.
Sorry
Yes,
to disturb. Can we treat this as 116, a right to use toll?
no, that is different. That is for mines, minerals, those things. So the toll will fit into only the collection mechanism. If the recovery is very difficult to estimate, because how many users will use, uncertain. That's why the best account which will suit it, this is established to be best account to suit is intangible asset. But if government interfere and then say we will promise you 240 crore, then we can take it as receivable financial asset, because there is certainty of 240 crore. And there are two elements of service. One element of service, that construction service. Second element, maintenance and collection. Recognize revenue differently. 115. So moral of the story, it cannot be fitted into 40. Because of this point, the probable economic benefit is not use alone. I mean, if you collect 4 rupees, 5 rupees, there is nothing like this now. 40 rupees, 50 rupees for each use. It doesn't mean that's the only economic benefit associated with the road. Virtually the control over the road we don't have. So these two are the criteria. Here also we recognize asset in the toll road scenario I said, but under which get different head. That is under intangible asset. Initial measurement will be a cost. Our cost should include purchase prices, all other taxes. What are they? Normally stamp fees, registration, legal expenses, all these are added. It does not include initial estimate of dismantling, right? Here very different. The cost does not include initial estimate of dismantling. Cost of, I mean, dismantling cost will not be included. Cost of bringing the asset to its present place of use. Very rare in Indian context. Bringing it to the place and all, very rare, but possible. Then leased asset, you have to go by fair value. I said clearly, present value of lease payment, whichever is low. If you buy a laptop from your client having a laptop shop, undoubtedly auditor means with a lot of happiness, normal understanding. Auditor and client relationship better. So they offer a discount. Price of the laptop 50,000, they give 5,000 discount. Now I have to account only at 45,000, right? Invoice will be there for what I cannot account it at market value of 50. That's the logic behind taking it at lower of fair value and present value. So whichever is lower, this is based on the other standard. Since it is not applicable, I mean the fair value model not applicable for Indian context. Also, I skip this IAS discussion. So we can recognize it based on cost and disclose the fair value. And it also requires disclosure of our extent of interest and in which model you hold the investment property, whether lease or on ownership model, all that. Now, we have to measure based on fair value, and without measurement, where is the question of disclosure? So for disclosure, an entity shall adopt cost model as its accounting policy and apply to all its investment property. They have to measure fair value only for disclosure. I told you this already, so I skip this. In fact, I gave you a simple example of a person having land, introduce that in the business, and then they become a property developer. In our PGBP class, income tax, we would have studied the mechanism, basic mechanism. It is like that, but couple of important points here. If there is a change in use, there may be a requirement to bring it from investment property to owner-occupied property. I mean PPE. In such case, Ind AS 16 will apply on the date of transfer. Sometimes if it is development with a view to sale, then from investment property, I should shift it to inventory, Ind AS 2. That is where I said PGBP class. Owner-occupied property can be transferred to investment property from 16 to 40 when the owner decide, let us vacate our factory or let us vacate the staff and keep it maybe for capital appreciation. Then that is the end of owner occupation. It will shift to 40. Investment property no doubt come under only non-current asset. Only 105 is the exception. If you decide to discontinue the operation, or if there is a binding sale agreement through which they decide to sell or hive off we are having a division. In that property division, there is a property, and we want to hive off that division, then it should be shifted to 105. From that day, it will, the depreciation will stop. It is as good as a current asset is the view. That's why that title 105, non-current asset held for sale. Property under construction, there is a possibility. So we have to take it to 40 when there is end of construction or development. When will we derecognize? Of course, when there is a change in objective, withdrawn from use, no future economic the benefit expected. In those cases, this is called retirement almost. Kabul is the example I gave. That is where it can become of no use. The gain or loss arising from retirement, right? It shall be recognized in P&L at the time of retirement. So the same provision like our Ind AS 16, there also the concept of retirements are there. The minimum disclosure requirement, the accounting policy followed for measurement. If there is a change in classification, you have to give that information. Fair value, undoubtedly you have to disclose. Related financial effect also. The amount recognized in the P&L for few things, rental income or operating income from investment property. Look at the beauty now. This standard never discussed the measurement requirements, measurement provisions regarding income. There is no provision at all. 115 only discuss about the rental income, all that. But this standard require you to disclose, require you to recognize separately. Through a presentation, separate presentation, we should ensure that the rental income separately presented. Other operating expenses, how are we going to present? The operating expenses relating to investment property, but did not recognize, but did not generate, not recognize, did not generate income. That should be presented separately. With this disclosure requirements with which I summarized, the requirements are over, and I hope we can come to the fag end of the presentation, and if there is any questions, we can take it up. This is what I was telling you, the last thing. The amount recognized in P&L for rental income and direct operating expense that generated rental income, so that the user will get enlightened. The user will come to know, oh, this much are the properties for which we spend a lot. We incur a lot of expenses, but we did not get any revenue, so that our top line, there is no change. On consequence, bottom line also no change. Top line is the corporate language of turnover. So like that, the user enlightened, for that purpose, we disclose them separately. So with this, if there are any questions, I would like to take up those questions to the best extent possible. We will try to answer. Any questions you can ask now. In the meanwhile, I thank the entire the SIRC team. Because of professional ethics, I may not be able to quote each and every one. So the organizers, I thank for this opportunity to share the thought process regarding these two standards. Actually, they are very vast. I tried to simplify so that there is no view of it is very complicated. It can be simplified for sure. So with that approach, we deliberated. I believe like it was useful to you. Thank you all for your time on a Saturday, that too in this slot. Thank you. What is the status of BOT? Sir, one question has come. What is the status of BOT annuity project with visibility gap 49%? See, this BOT, build, operate, transfer. This model, how it works is, actually it is executory contract kind of a category. So it will be within the purview of 150. Build, operate, transfer. You have to segment it into 3 categories. Build, for that service, if there is a fair value which can be established, if your consideration is a composite consideration, that should be recognized as soon as the related service complete. Operate, that is a that is a phase over the period. See, now there is 2 different paradigms. One is fair value, you were referring. I will come to the fair value, few more. The BOT, build, operate, transfer, build one element of service, operate over the period. Now there is a paradigm shift. At a point of time, over a period of time, there are two concepts. This operate will fit into over a period of time revenue recognition. Transfer, that has to be present value based. That's the, I mean, I am discussing a very lengthy point in a nutshell. Okay, there is another question. So marriage, gall, rental, undoubtedly it is business for them, so it will not be investment property. So then what is the status of BOT? That is answered. In slide 6, you are referring fair value. Is this fair value connected to investment? Exactly. Arun Kumar, it is fair value connected to investment property. Correct. There are a few more. Cost refer to fair value. Does this refer to investment property acquired in a merger? Actually, Arun Kumar, your 103 100% revolve around something called acquisition date fair value. Imagine a amalgamation merger. In US GAAP not applicable. US GAAP different story. I have to speak completely differently. In US GAAP there is no requirement to disclose investment property. So I make it clear. I am not even referring to any point in US GAAP. US GAAP there is a different requirement. They need not even present it as a investment property. Now I'll come to this point, fair value. So 103, what happens is there is an inherent requirement to recognize everything based on fair value. I'll tell you an easy point. There is this due diligence process in all the merger acquisition, due diligence. And as professionals, we sit along with us, there will be a team, you know better, architect, legal, I mean, the legal experts, advocates, or however designation you call, and then the actuaries, and there are other professionals. Now we have a balance sheet of acquirer, selling company, and the balance sheet value 30 lakh. Today's market value 30 crore, land and building. See, the co-professionals sitting with us, they are asking, sir, what is this? I don't understand your accounting. A property which is worth 30 crores, because I don't know debit or credit. A property which is worth 30 crore, your co-professional is putting it as 30 lakh and signing. Now, genuinely what we used to say immediately, that is called accounting standard. And there is something called accounting standard. We are bound by our own code. And you refer so and so page, there will be fair value. When at least this is possible, if it is disclosed. If it is not even disclosed, we have to convince them differently. Why I tell this issue? Just because it is sitting at balance sheet at 30 lakh, old accounting standard 14, no issue, no compulsion. I can take it at 30 lakh. Now imagine we are paying a composite consideration of 30 crore only for the sake of land held in that company. That is a defunct company, nothing, selling company. Old standard 14, no compulsion to take it at market value. I can take it at 30 lakh. Difference, what will you do? Your old accounting standard. I'm not criticizing. This was the loophole. Even old standard, there is scope to revalue. There is scope, but not compulsory. So what we used to do, take it at 30 lakh. 29 crore 70 lakh, I will call it as goodwill. What a flaw it is. Is it not misrepresentation? What a flaw it is. See, a defunct company, in what sense they will have goodwill? So that was the loophole plugged in 103. Now what is the scenario? Your mantra is acquisition date fair value, acquisition date fair value, acquisition date fair value. Throughout 103, one exception, commonly controlled transaction. This provision of acquisition date fair value should not lead to sugarcoating your losses as goodwill and bringing it to the new balance sheet. That is why they said, go by book value for commonly controlled transaction. Other than commonly controlled transaction, present scenario, fair value is presumed to be your cost. That's why that point, Arun Kumar, I hope you would be convinced. Now, I don't have a choice in 103 to adopt any value other than fair value. 4 more points. So thank you. Those are just wishes. Thank you so much. Any other queries? I think we have come to the conclusion stage. Over to Gopalakrishnan sir. Even then, if you have some query, we can answer. Definitely, we will share all the presentation. No problem. Sir, over to you, sir. Thank you.
Yes, sir. Thank you, sir. Thank you. Dear members, I think the morning session, the topic on AS 37 and 40 you will all agree with me that yes, sir has taken us in detail both the standards and also highlighted wherever possible the related standards which are applicable, and you have exhibited your in-depth knowledge, sir. Actually, your threadbare shown where exactly the systems has to get across, which standard has to be referred, and all the comparison. I think it was a wonderful session. It was a wonderful morning session, and I thank all the members who have been live. I think it was 100 full packed for the last 1 hour or 2 hours, and I thank each and every member for being with us in this session. On behalf of SIRC, I thank Shanmunathan sir for making this wonderful presentation, and thank you, members. Thank you all.
Thank you. Thank you all of you. Thank you for the thanks message also. Thank you all.
Thank you, sir. Thank you, sir.